4? Oh, yep, this is it. So we're talking, so Chapter 3 was Business Income and Expenses Part 1. Now we're in Business Income and Expenses Part 2, which is just really digging into more of the same things that are going to show up in that same part of the tax return on the top of the 1040. We're going to talk about rentals. We're going to dig more into farm. So everything that kind of goes up in that top section of the 1040. Okay, so I think it's probably best if we start by pulling out a Schedule E and looking at what the format looks like. I myself don't have my book, but if you have your book, pull it out. Chapter 4, you will find the 1040 Schedule E somewhere in there. And you find it, just color out the page numbers so you can get there. Page 47. Thanks. So, actually, I'm going to look over your shoulder if I can. So, part 1 is obviously the whole front page on page 4-7. And then, no, it doesn't have part 2, it doesn't have the back page. Well, at any rate, we're only going to be working on the front page, so that's fine. So basically, you can see that it looks just like a Schedule C, except for all of the line items are specific to a rental, right? Advertising, cleaning, management fees, mortgage interest, and then it's got 3 columns across, A, B, and C, so that's if you've got up to 3 rentals. And really just FYI, for a heads up, when you fill out, so the software is going to look pretty similar, the input screen is going to look pretty similar to part 1, but you have to be really cognizant of what you could enter as input up in that top section. And you'll see that as we go through this. There's a couple of innocuous boxes that if you check them wrong, you're not going to get the results you want. So I'll talk about that as we get there. So the first issue that they talk about with rentals, so a straight up rental, there's really not that much to talk about. But what they're talking about here is that you have property that you use partially for vacation and partially for rental. And you have to figure out how to categorize it in one of 3 ways before you can figure out how it's going to flow through your tax return. So if you have both personal and rental use, you have to allocate the expenses. And that describes a lot of people around here. So the first category is it's primarily personal. So that means that I rented it for less than 15 days. And like we have friends that have places up the Flathead, and that's what they do. They rent it for 2 weeks. Right? And they basically make their money to pay their property taxes, but they don't have to report it. It's primarily personal. If it's a category 2, that's going to make it a little bit complicated because that's called, that's 3. So category 2 is primarily rental. So if you rent it more than 15 days and your personal use doesn't exceed the greater of 14 days or 10% of rental days. So, okay, because I was just saying that could be me. So the second one is, say that I personally used my rental, say that I have a place at Flathead, and I personally used it for 60 days, and I rented it for 150 days. So I'm trying to figure out, obviously it's not primarily personal use because I rented it more than 15 days. So I'm trying to decide between category 2 and 3, and this is the piece that gets, that you really got to dial into because it depends upon how much of your expenses you can pay. So did I rent it more than 15 days? Yes. Did the personal use exceed the greater of 14 days or 10% of rental days? So I would actually write that out. So 10% of rental days obviously is 15. So which is the greater of those 2 numbers, this one, and did the personal use exceed that? It did. So you're going to go down here to category 3. Does that make sense? Because so I rented more than 15 days. The personal use does not exceed the greater of 14 days, or 10% of rental days. It did. So you're in category 3, right? Dual use. So let's go and take a look at how you treat each of these scenarios. So if it's primarily personal use, you don't have to pay tax on the rental income at all. And you take your mortgage income or your mortgage interest and your real estate taxes straight to Schedule A, just like you would any other property. And everything else, like your utilities and your maintenance and all that other stuff, is non-deductible. It's just personal. So really, it's kind of a loophole. You get that free rental income. Yep. So that's pretty straightforward. So you don't use a Schedule E at all. If it's primarily rental, you're going to allocate your expenses between an A and an E. And it's based on this calculation here. It's just an allocation of the number of days. So for example, here together, I used it 210 days, right, in total. So 60 210ths is going to be personal, and 150 210ths is going to be rental. And this is where you get into the, this is kind of a hard thing to introduce, but these passive loss rules. And there's no way to make this easy, so I'm just going to try and give you a broad brush stroke. So do you remember there was 3 kinds of income we talked about in Chapter 2? Active income, portfolio income, and passive. Passive income is basically stuff that we don't do anything to earn, right? So you've got this rental, it's not portfolio, and you're not actively earning it. The IRS really limits the losses you can take from passive activities, because oftentimes they're tax loopholes. Okay? So in this scenario, in a primarily rental, if your deductions exceed your income, you can deduct them against your regular income, but it's subject to limitations, to passive loss limitations. They're called PALs, passive activity losses. And then the personal part of your mortgage interest and real estate goes over here. So we're going to be doing a lot of allocation, right, where we've got a percentage to the A and a percentage to the E. And then all your other stuff, like your utilities and your repairs and maintenance and all that, none of that obviously ever goes to your A because those are personal, right? But you're going to get a percentage of that over on the E against the rental income. And we'll talk more about what it's limited by, but also always keep in the back of your head that you have these passive activity loss limitations. But you don't know exactly what that is quite yet. And then this is basically when you've got the dual use. It's exactly the same. You're going to make the allocations based on the days, but you have this very specific thing that we have, which is exactly the same as office and home, where it can't take you into a loss situation. That's what that second bullet says. So you get your deductions. You take your taxes and you take your interest and you take your utilities and maintenance, but you can only take them up to the amount of your rental revenue. It can't take you into a loss. Okay, so we're going to walk through a couple examples. It's easier to really do than it is to explain in words. So the first thing you have to decide is which of the 3 categories it is. If it's primarily personal, there's no allocation. You don't have to set this up at all. If it's primarily, or if it's a dual use or primarily rental, then you do have to set up this allocation. If it's primarily rental, you have to think about passive activity losses, which you don't 100% know what that is yet. And if it's a dual use, you can never, your Schedule E can never take you into a loss. If it's dual use. So that's just kind of the backdrop. So the math is super easy. It's just making sure you get it in the right category. Okay, well, I didn't really want to tell you it was dual use, but I did, but I want you to figure it out. Okay, so the Mavali family owns a ski condo in Alta, and in the current year, they used it for 25 days, and they rented it for 50 days. And the data pertaining to the rental follows, and I want you basically, this problem, first off, I want you to prove to me that it's dual use based on that prior screen. And then I want you to actually do this schedule for me. So just pencil it out. So your denominator, obviously, is going to be 75. So first I would go back to this screen and prove to me that it's a category 3. Okay, so the first thing you should have done is proof this, right? So I'm just walking through sort of the word problems. So for category 3, was it rented more than 15 days? Yep. Did personal use exceed the greater of 14 days or 10% of rental days? So I put those two numbers next to each other. I circled the one that was greater, and yes, my personal use exceeded that. So, always write that out. I have to write it out. It's not intuitive to me. So then I know, okay, cool, I'm on category 3. Okay? Okay, so...
again, the personal expenses are the ones going on Schedule A.
Yep. But you can only take what you would normally take on an A, which is interest and taxes. Right? So like my utility bills are deductible personally.
And so you're taking only the 33% of the taxes.
Yes. Yeah, 2/3 to the E, 1/3 to the A. Does that make sense? Okay, good. Yeah, once you get it, but it's kind of tricky to get a hold of it at the beginning. But it's a lot like office and home, where you get what you would normally get, whether you had an office and home or a rental, which is your Schedule A stuff. I added up the total. Oh, of course. It's all good. Just keep clarifying. And actually, these numbers are kind of silly because they've got a ton of depreciation, which means it's a really expensive condo, but their taxes are only $1,500 a year. So bad numbers. Probably closer to 15 grand.
Okay, I'm just keeping on that.
Yeah, it's a killer deal. And this is, I mean, regardless of how you feel, this is another one of those things that people with money get tax write-offs on. I mean, if you can afford vacation property, lucky you, but there's also tax benefits. Okay, so here's what happens here. With a dual use, we know that they can only take the expenses up to what? What was the income? 10 grand, right? So I did my schedule. Tell me what the numbers were. So let's see, my A and my E. So how much was my interest for the A?
1,000.
Oh, let me get this focus in right here. There we go. Okay, stop.
Or you wanted all of it, I'm sorry, 3,000.
For the A?
Oh, for A, it's 1,000.
Yeah. So 1 and 2, right?
Yeah.
And the taxes are 500
Right.
and 1,000. My income was 10. Okay. So then we're taking utilities and R&M, and what was my utility split?
A, I got 667, and B, I got 1,333.
Is that what everybody else got? But you don't get the utilities number on the A.
You do get interest though.
You get, what is this doing this for? So the way to remember what you do and don't get is pretend this wasn't a vacation home at all. It was just your house. What would you get on the A? Right? You get your mortgage interest, you get your property taxes. Right? You don't get anything else, so that's just personal stuff. Right? So that same thing holds true if it's a dual use vacation property. Yeah. But you get a percentage of everything for the rental because that's the part that you're thinking about. It's like you owned a duplex here in Missoula that you rented out. You get all your expenses on that, don't you?
Yeah.
What was my R&M for the E? Oh, you didn't?
No.
Oh, snow removal, okay. How much was that
2,500.
in total?
Yeah, the total was,
I can't do that in my head. It's too big.
it's 1,667.
Thank you. Okay, and then the depreciation was 12 grand, and that was 2/3 of that, right? That's to the rental. Okay, so here's the issue. so irritating. I don't know what it's trying to focus in on. It's, oh, thank you. That was up here. And how much was that for the E? Just for the E? Thanks, Katie. So basically what we have to do is just, we get to deduct. This is like a very long, bad night.
Do you
Um,
lock it in the right there?
I don't know how to do that.
Adjust your hands and put it under there.
Yeah, I know when the hand's under there, but I don't know why it's doing it. I don't know how to lock it. I guess I should learn. Huh?
I'm pretty sure that was crappy.
Yeah. Okay, so let me make a point here. If, for example, if I put good numbers up there and the section E percentage of taxes was 11,000, that could actually take them into a loss.
Oh, so they are allowed to take taxes?
It's just like office of home. The interest and the taxes can take you into a loss, because if it didn't exist, you'd still get it all on your A, wouldn't you? So you can get those anyways. So those first two things can take you into a loss. And they're not, in this example, you still got $7,000 to beat up. But if those first two numbers were 13,000, you would show a $3,000 loss from your rentals. That's allowed. But we're not doing that. We're just going item by item by item to see if we have enough revenue to absorb it, because that doesn't take us into a loss. What we do know about this is it can only take us to zero now. Okay? Okay. So I'm going to get all of this. I'm going to get all of this. 4333, 5333. What's that? 7,000. And I'm going to get $1,000 of depreciation. $3,000 of depreciation, right? 46, 56, 7, 8, 9, 10. Yep. So that takes me to zero, doesn't it? And I've still got $6,000. Oh, this is not working for me this morning. I've got $6,000 that I'm going to carry forward as a rental loss. It works exactly like office and home does. So let's go back and look at this. Wait, so why is that different?
Yeah, it was 8.
Oh, this is 8. Sorry. Yep. So it's a $5,000 carry forward, correct?
Yeah.
Yeah. Okay. So I didn't split it out into two tables on this slide, but I think it's easier to do this way. And if I were you and I was setting one of these up, I would write all of my expenses, and then I would just immediately put lines through everything on the A that wasn't interest or taxes, just to prompt yourself like, there's no allocation to be done here. Now, if you've done the math on that first slide, right, and you figured out that it was category 2, could you have taken it into a loss if it was primarily rental? Yeah, you can. You don't know what these passive activity loss limitations are yet. I'm going to teach you that in a sec. But you would have shown on this one a $5,000 loss. Right? So it's only on the dual use that you can go to zero. We'll practice some more of these. Okay, I don't want to talk about this. Well, so this, not to confuse this, but there's dissension on whether or not, some people want to do this. They're like, there's 365 days in the year, so I want to do my allocation like this. And the tax court has allowed it, but the appellate courts haven't. That's probably more than we want to get into. We're going to do our allocation based on the denominator I just showed you. The book talks about this discrepancy between the appellate and the tax court. Okay, so just reiterating that there's these three types of income: active, portfolio, and passive. Passive activities are usually associated with some sort of tax loophole or tax planning. Most of us don't have access to limited partnerships and REITs and all these kind of funky instruments that are passive. But the one thing that a lot of regular people do have that's passive is rental real estate. And there's very specific rules around it. So the first rule, they're called PALs, passive activity losses, is if you have very little involvement with an activity, it's called passive, and you can't ever deduct those in excess of passive gains. So say, I've got some, when Plum Creek used to have a big presence in Montana, all of their shares of forest were held through limited partnerships. And I had a number of clients that had ownership in the limited partnership in Plum Creek. So say you had a couple parcels that had gains and you had a couple parcels that had losses, you could take the losses, but only up to the amount of the gains. It couldn't throw you into a net loss that you took against like your W-2, right? Because you weren't earning it. It was passive. You can always take your passive losses forward in the hopes that you have passive gains down the road. But the general rule is that you can't ever use them to offset active or portfolio income. Okay, so you're limited. Because they're generally tools of high net worth people. But the exception is with rental real estate. Rental real estate is specifically designated as passive, and you should probably put this in your notes. This is where one of those little boxes I was telling you in the software, at the very top when you go in the software, it asks, I think the terminology is, do you actively manage your property? Do you materially participate? And I think this is really confusing verbiage because, you check, I actively manage it. I vet my tenants. I do the turnover when people leave and people come in. I paint it. I do all the repairs and maintenance on it, blah, blah, blah. But it's still a passive activity. So that's kind of an oxymoron. But you have to click that box to get any sort of activity populated on your Schedule E. Even though what I'm teaching you is, by nature, rental property is specifically designated as passive, you still have to click that box.
Would materiality be like having a property management company and it's not?
Yeah, but my experience, it is. But my experience is when you mark that box, wonky things happen on your E. Even if I have a property management firm, I can still take, it's still considered passive, but I can take these losses up to what we're going to learn about. So I would just always click that, yes. But yeah, that is what material participate means, but I struggle with these boxes at the top of the Schedule E of the software. Okay, so here's what makes rentals such great deals. First off, and I think I've told you this before, I took my finance class. If you're looking to get into the rental market or into real estate, the very best favor you can do yourself is find a duplex or a starter home. Because you're going to have somebody pay for half of purchasing a home, right? So for most of us, our first foray into rental property isn't like, oh, I think I'm just going to go pick up an apartment building. It's like, I'm going to find a little duplex. And that's what we did in Colorado 30 years ago. And you have somebody next door to you, and it might not be ideal, you're sharing back there, whatever, but you've got somebody paying it, really helping you pay down your mortgage quickly, gain equity quickly. Secondly, even if you've got cash flow from it, you get to take a tax loss because of the depreciation. So I can't think of another example where I've got positive cash flow and a tax loss. That is the absolute double whammy of any situation. And they're buying new equity in a starter home. So I mean, it is just the golden entrance into real estate.
So are those considered two different properties then, because they have two different addresses, or is that like a dual use since it's one building?
So it's not a dual use. I've got like one primary residence and one primary rental. Good question. So what it does is that I get to take, even though it's passive, I get to take up to $25,000 of rental loss against ordinary income, and that's going to happen from the depreciation, most often. But, there's an exception to the exception, if you make a good wage, a good modified adjusted gross income, for every dollar over 100,000, you lose the loss 50 cents per dollar that your modified adjusted gross income is over 100. So what am I telling you here, really? Let's just do the broad brush strokes and then we can do the numbers. It's not as bad as it looks. It's for exactly what I was describing. Two young people starting out, first jobs, don't have very good W-2, or very much earning power at that point, buy a little duplex, we could take our entire loss. But then once you get higher earning power, you get over that 100,000, they're saying, hey, now I'm going to start phasing out the amount of loss you can take from your rental real estate. But you don't need it as much then. So that's another kind of sweetener. Okay, so let's just take a look at the math. Okay, I'll go back to that slide while we're thinking about this. Okay, so we've got a gal. She's single. She owns a rental duplex, and it shows a loss of $20,000. And her modified AGI before the loss is $118,000. So she's got good portfolio and active income. So we know that in no situation Bobby Joe could take more than $25,000. That's always the limit, right? She's got $20,000 of loss. Our question is how much of that can she take? So what the rule says is for every $1 that her modified adjusted gross income is over 100 grand, she loses 50 cents of that 25 grand capacity. So how much is her modified adjusted gross income over 100,000?
18,000.
About, what's 18,000 times 25?
9,000.
9,000. So see, the math isn't that scary. The part that a lot of people miss is you don't subtract the 9 from the 20. You subtract the 9 from the capacity, which is what? 25. That's the most she could ever take. And that has been reduced by $9,000. So you don't take the 9,000 from the 20. You take the 9,000 from the 25.
So she could take 16 then?
Yep. So 18,000 excess, 18,000 times 50%, so she loses 9 grand of capacity. 25 minus 9, she can take 16. And then the second question asks, what if she only had $2,800 of loss? She would roll 2,800, right? Okay, do you want to do one more of these? Let me just put one up. I'm just going to put it on the board because I can't deal with it. Wonky and an out. Okay, while I'm putting this up, let me just tell you what that other slide said, which is all the rules about real estate are different if you're a realtor. If you work more than, or actively say I have 30 rentals, and that's really what I do. If I work more than 750 hours a year in real estate, all these rules I'm telling you are different because I really then go to a Schedule C. Does that make sense? Okay. So that's what that said. So let's say there's a couple married filing jointly, and they have 2 rentals, One rental shows income of $6,800, and the second rental shows a loss of 24. Let's see if I can figure this out. I have 17, and their Maggi is 115. Okay, so what do they get?
So even if they're married, filing jointly, the 100,000 number.
Yeah, for sure, that's the same number.
Okay.
Yep. The only case that's different is if they're married filing separately.
Would that oftentimes be beneficial if they have a lot of rental income, if.
Yeah, that's a good question.
No, but they never run that.
If that's all they do, you may be able to make a case that that would be, if they're gonna split it on Montana for sure. It may be. I can't answer that off the top of my head. It would depend upon the other numbers.
Is that 25,000 limit per rental or?
No,
all
it's
together?
total. Yep. So the first thing you do is you net all their rentals. So what did they have? 17.2. And I have to really think about this stuff too. So it nets this. So I netted the losses, so they had a net loss of 17.2. Then I did the math, how much was their modified adjusted gross income over 100,000, 15 grand, 50% of that 7,500. And then I have to reduce this number by what I just calculated, right? So they're limited to 17.5. So do they get their whole loss? I think they do, don't they?
Yeah, just
Yeah.
the 17.2, they can't take it up. to
Oh, right, yeah. They get their loss, their whole loss. Okay, you understand this? So let's just kind of go through now that that's really the whole picture. So category 1 is what? Personal. What do I do with that? I have my condo up at Whitefish Mountain, and I go up there all summer, and I rent it for 2 weeks when I go out of the country in January, and I pay my taxes with it. What do I do? I get my mortgage interest, I get my taxes on my Schedule A. I don't have to report my 5,000 bucks of income. And what do I do with all my utilities and my snow removal and my maintenance? Nothing, just personal expenses, okay?
But it's free
Go ahead.
income.
But it's tax-free income. Okay. Category 2 is what? Primarily rental. Now, what's the scoop? What are you going to do if you make the assessment that it's a category 2? You're immediately going to do what? I'm going to set this guy up, right? And I'm going to draw the lines on anything. Insurance is always in here, obviously. I'm going to draw the lines on anything in my Schedule A because I don't get those. And I'm going to do my allocation with the denominator being what? Total number of days, and then obviously however many days are split up. Primarily rental, can it go into a loss? Yes, that's what we're doing here. Right? That's what we're doing here. Your first gut feel would be like, no, it absolutely can't go into a loss, it's passive, and we know that passive activity losses can only go up to passive activity gains, but there's a rental real estate exception. But then I've got to make sure to look at my modified adjusted gross income because the rental real estate exception can go away if I'm high income. Once your modified adjusted gross income gets to 150 grand, you can't take rental losses. And this is a tough one to explain to clients because they'll come in and be like, well, my brother bought a rental and he has, just what I just told you, positive cash flow and a tax loss. And I'm like, well, you're a doctor and he's a carpenter. So you're not going to get your rental losses. Okay. So that's all this, right? And then category 3 is that dual use. And that's the one that's a little tricky. What does that say? I do this, right? But what does that one say that's different from category 2? You can take a loss, but only if it's attributable to
Taxes and interest.
exactly like office and home. Remember, office and home can take you into a loss if it's attributable to taxes and interest. Tanner's like, oh, my head hurts.
I'm just wondering who thought all this out.
Okay, good. Yeah, stretching's probably good. Have we been at this an hour?
So on the Schedule E, you stated that on the front of it, it just has room for 3 properties. So if you have more than 3 properties.
If you have more than 3 properties, you just keep entering them in the software and it's going to print out an ancillary schedule to go with it.
And total them all.
And total them all.
Okay.
Start reading next up. I'm like, what is that? Okay, this isn't anything too crazy. I'll give you back your book. We're basically just going down the 1040 and looking at things that are on that front page in chapters 3 and 4. So I'm not quite sure of the order of this. So the rental, can you tell me on a 1040 what line your rental all flows to? Which line is it? 17. And then is there any way we can see the back side of the Schedule E? I didn't see that on the, let me see if I can pull one up. Forms and instructions. Okay, Schedule E. Oh, no, I did one for a 990. No. Where's just a Schedule E? Instructions. Huh. Other. No, I don't want the instructions.
There's one on 453, on page 453.
Okay. Yeah, let's just go with there. I don't know why I'm having a hard time with this. So if you look on page 453, I just want to take a peek because the book only talks about the front page of the E, but there's actually funny things.
Oh, no. I thought, I just
Okay,
thought.
I guess we're just not going to see it, but I'll just tell you. On the back, if you're in a partnership or an S corp, or if you have royalties, that all goes on the back of the Schedule E, and that all flows together to that line 17. And you will have clients, lots of clients that are part of it. Like, it doesn't even need to be some big fancy S corp. Like, I've got a gal that I've told you about, that's my weaver, and she's a partner in Raven's Art Gallery. So she gets a K1. That goes on the back of the Schedule E. We're not doing that, but you will have activity on the second page of the Schedule E.
I just Googled it, and I mean, it is pretty in-depth, the second page, so.
Right, and they don't cover it in the book, but that's not to say, I mean, I have tons of clients that have, that are shareholders in an S corp or partners in a partnership, and that goes on the second page, and it all flows together. So that makes the manual recap really tricky because you got to think about rental and partnerships all in the same breath. But you're not going to have to do that, but just be aware that's there. Okay. So now we're just still on that general front page of the 1040, and we're just sort of picking out, I don't really understand the order here, but all stuff we need to talk about. You've seen this. If I'm self-employed, I get my health insurance on the front page of the 1040. How is that different from somebody like you or I that pays our own health insurance premiums? And we're not self-employed, sorry. We're an employee. Where did those go? I think they go into Schedule A. Right? So if you pay your own medical premiums and you're an employee, it's a Schedule A expense. And you don't know this yet, but your medical expenses have to be more than 10% of your adjusted gross income to get them. So this is a benefit that it gets to go on the front page, isn't it? So there's really nothing crazy here. It's your medical and dental for yourself, your spouse, your dependents. This last fourth bullet here, long-term care insurance premiums. Does anyone know what that is? We heard that. Go ahead. Yeah, we're not called old folks. I have to help me, I've got corrected about that. They're called SNFs.
That's worse.
I know. My mom went to one of those. I thought, what? It's something nursing institutionalized facility. It's not a prettier name. That's what it is. Senior nursing something facility. Anyway, if you pay premiums to protect yourself, when you get older and think you may be in one of these facilities, that goes up here. The way those work is the earlier you start purchasing them, you lock in your premiums for the rest of your life. So like at my age, if I started buying them, I would pay $250 a month for the rest of my life. If you don't start buying the insurance till you're 70, it's going to be $800 a month. You know, so it's, I mean, you lock it in when you're younger. With that said, they're sort of new. They're only about 8 or 10 years old, and there's been a lot of insolvency. So people have paid into it for a number of years, and in the assisted care living is very expensive. And they've gotten all your money for all these years, and they're like, "Oh, sorry, dude, that math wasn't right. We can't actually offer what we've taken from you," and they just declare bankruptcy, and you don't have a place to go, and they've got the money. So I would be, not that I interview the age where you're looking at those, but be very, 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 very careful. With that said, most people don't save enough money to have $10,000 a month to pay for long-term care.
Which is why you want a cruise line.
That is the craziest idea I've ever heard, but it's a great idea, isn't it?
And cheaper than a nursing home.
So much fun.
Yeah.
You can work out every day, somebody takes care of your room, you have your meals.
And I don't have phone.
Yeah, did I tell you about that?
Oh, I can go about it.
You've read about it, you told these guys about it, it's hilarious.
Oh, just this old lady decided that she wasn't going to go into a nursing home because she couldn't afford it, but the cost of going on, basically she lives on a cruise ship and just goes on all the tours and has her same room and knows all of the employees and sees the same people come on and off yearly and has made all these friends and has medical care and is paying like a fraction of what it costs her to be.
Permanent cruise, she's on a permanent cruise. Gosh, that sounds great.
So sold all of her assets, so she doesn't have a home, she doesn't have a mortgage, she just pays like
Our friends that cruise, I mean, I can't imagine it would be on a cruise ship, but our friends that do that meet people all the time when they cruise that do that. This is where I live now.
I mean,
You have friends,
Right.
you have friends, you have physical activity, you can eat as healthy as you want, or sunshine.
Swimming pool.
I mean, I don't know, it doesn't sound that bad if you're a cruise ship kind of person. Had you ever heard of that?
Yeah.
I just thought it was a crack up. That makes a lot of sense.
People in the middle of the ocean, that's awful.
It was.
I'm such an introvert that being on a ship.
Oh, in the middle of the
Isolated with other people sounds like the worst.
Right, yeah, cruise ships are there's pretty interesting dynamics. One of them being the idea that when people are put in front of free food,
They eat a lot.
they change their eating behaviors, and it's quite unseemly.
Gotta get your mind through it.
Oh, but, you know, I mean, in all fairness, if somebody says free wine, I'm probably not going to hold back. So everyone's got their own thing.
Like, I get it.
I get it, yeah, I get the concept, I just redo it on the buffet. Okay. Anyway, so your SE health is limited, we know this, it can't exceed your net earned income. This probably gets more technical than you need. Okay, health savings accounts, HSAs, can you remind me what those are? Do you remember from payroll?
It's hard to put money on.
And HSA is a health savings account that you can put money into that's tax-free when you use it for medical benefits.
It is, and your employer can put money into it too. And more employers, as their premiums are going up, are saying, I can't afford to cover you 100% anymore, so I'll cover you, but for your kids and spouse, I'll put a couple $100 a month into an HSA.
And it's basically like the high deductible. It's like emergency insurance, you know, like you have like $100,000 surgery, you don't pay taxes on it, so you really only pay $70,000 for the surgery if you have to use your HSA.
Right, well, most people don't get 70,000 in their HSA.
Right. But it also.
But, I mean, you could. I mean, you could if you saved money every year and you never had any out-of-pocket expenses. Lucky you could.
You seem pretty healthy.
So the flex,
Yeah.
the flex is the one that comes in every year.
Okay, right, thank you. Yeah, so the difference on that first bullet, healthcare, the last bullet, HSAs, is very different from the first one, flexible spending account, in two ways. How so?
The first one you can use dependent, like for your kids and childcare.
You can, yep,
With the other one you can.
right? Or sorry, so there's three differences, big differences. So one is dependent care, you can also run through a flex.
If you don't use it, you lose it.
That's a huge thing to pay attention to with an FSA. If you elect, I think I'm gonna have $2,000 worth of dental bills next year. So I put that in my flex, and then I don't need the root canal, I just lose that $2,000 if I don't spend it on something, right? So you have to be very careful with that. A really good way to use it, like we used to use it, like your kid needs braces. So it's like, okay, I know I'm gonna have that many expenses, but if you're only estimating like, we're gonna each go to the doctor once a year, get our flu shots, and get our teeth cleaned, I would always estimate conservative if that's what you're doing.
Why would you choose, essentially, you can still pay for those things out of the health savings account.
But that's the third thing. Why would you choose? Why is a flex more beneficial? You don't have to pay FICA on it. So it's the only thing that I know of that you don't have to pay any taxes on.
So, I mean, it could be a big benefit if you're putting.
Huge benefit.
A lot of money.
Huge benefit. Okay, and again, this is just tons and tons and tons of detail, but I mean, you do need to know this, that this health savings account, if you're looking at your 1040, it's a deduction for AGI, so everybody gets it. But it's only if you've got a high deductible plan, and that's identified as 2,600 or 13, which really honestly isn't high deductible at all. That's actually a pretty average deductible now. And then it's limited the amount that you can put in, essentially. And you put your HSA contributions on an 88, 89. It's definitely, I will tell you in all truthfulness, probably the last 5 years since Obamacare and these instruments have been designed, I would tell you the tax returns have probably gotten 25% more time intensive. And some commensurate billing rates go up. And it's hard to explain to regular Joes that are, carpenters and tradespeople. It's like, all of a sudden my tax return that always cost $200 now costs $300. And I'm like, you've got an HSA and that form 8889, and it's like, they're placed over, they don't care, where do I sign, how much am I getting back? But it's like, it's tough to explain, but it really, the whole medical system in this country, really, a lot of it flows through our income tax system. So it ends up on a preparer's desk.
Is that again something that as a preparer or tax professional, you could maybe lay out at the beginning of the year, these are the changes, like a
I do.
notification?
I send all my clients, it's the only paper, I'm trying to get them all paperless, because I envision being able to do it from wherever I am in the world someday. But I still send paper packets in December. And I line out all the changes, and and I try and bold on each individual letter how it's going to impact you, because I know you're different from Rena. But honestly, it goes out like at Christmas time.
So people don't look.
People are like, yeah, like I care about taxes. I'm trying to buy presents and
It's December, I don't care.
buy the turkey. Yeah, yeah, they don't care. So, yeah, and it also says things like you have to notify me before the end of the year, because once the end of the year is come and gone, I can't do anything to help you tax plan. And then the third thing that you should always know with clients that you have to tell them over and over and over and over, and some will never hear you regardless, is that when they're planning a transaction, they need to call you before it's effected. People call me like, oh, I sold my duplex. Oh my God, you should have 1031 that. You can roll your rental property into another rental property and never pay tax on it. And they're like, what? But that's what I tell you, you've got to call me before you do it. Now it's culminated. There's nothing to do. So, or I sold my business, or I'm getting divorced, or I'm playing the custody battle. And, you've got to call me before the transaction occurs. Okay, so in HSA, you put money in tax-free, or pre-tax when you take it out. It's tax-free when it's used to pay for medical expenses. Moving. If you move more than 50 miles, you can deduct your moving expenses. And you have a lot of people that do this. If you're going to work somewhere else, you have to work in the new place. I have to look at the numbers. Here it is. You have to work 39 weeks of the 12 months after you move, or if you're self-employed, 78 weeks of the next 24 months. So basically, if you do that, you meet the time and distance test, then you get to take all this stuff. You get to take 17 cents a mile for your primary car. You get to take the cost of your moving van. You get to, if you hire a mover where they come in and pack all your stuff, you get to take all those. So the cost of moving your personal items and your travel, you get to take your lodging, so if you're moving across country, but it's got to be reasonable. I'm moving to Minnesota via Florida. Doesn't work, right? People always try to do that. They take a vacation and then they're like, can I make this off? It's like, no. So they've got to be reasonable. That's also a deduction for AGI, so everybody gets it. So we're just basically just kind of jumping around the front of the 1040. Okay, should we have a stretch?
Yeah.
Let's just take a little break. My heart hurts. And, this is kind of a complicated area, so let's just, have a little stretch, a little yoga. See how much more we've got. Oh, yeah, we're only halfway through this chapter. It's kind of weird they throw in all these sort of unrelated topics. Tobin, what did you
I was
email me about?
can meet on Monday or Wednesday.
Yeah, sorry, I read it really late at night. What was the reading about?
Last sentence.
From here,
Yeah.
to take a look at your
Yeah.
memory. Kevin asked me to do that too, so maybe you can do it this time. Okay.
That won't be awkward.
So office hours are, let's see, 12 to 1 on Mondays and Wednesdays, but are we just thinking we want to be somewhere where you guys And you don't need to be on the computer.
No.
No.
So are you available on Mondays or Wednesdays from 12 to 1?
Or,
Is that what we're talking about?
yeah, I was thinking different times I'm at GCCS provision, but
Okay, well, like, what time are you talking about?
like after business stuff.
11 or 12.
Oh, I have,
Okay, are you available in the afternoon, like at 3:30?
after the fight. Oh, that's like, yeah.
Like,
But like encouraging people to do maintenance?
yeah, that's just working on the piano.
Which day do you guys have Monday?
Well, I've got to look and see if I've got anything. Is that the 8th? And guest speaking on the campus.
I think,
And Wednesday I've got a union meeting. Okay, so can we go to Tuesdays and Thursdays and talk about that?
yeah.
Oh, how about tomorrow? The 5th? I've got a main campus meeting at 4 and then I'm class at 2.
It's like an hour or so.
Well, it's whatever y'all need. I mean, my hope would be, my hope would be less than an hour. I mean, do you have specific questions?
Yeah.
Yeah, okay.
I just have to, I think I work at 4, so,
You work at 4?
yeah.
Okay, could you do it at 2? 2 to 3? Well, okay, so, why don't you come to my office and I'll see if I can get the conference room on the first floor so that we can set up. So for 2 o'clock on Friday the 5th. Yeah. Okay. Just write a quick email and then. See the tax cases, not the source documents, but the actual cases. That you print out from there. Maybe it'd be good to break up today. The first case is only on rental, so if you can do some of that, that's what I got to call you. Okay. Yeah, you know what, rather than just talking to you for another hour, because that's hard, 2 hours is hard for me, it's hard for you. Let's just spend the next 45 minutes working on our manual recaps for number 8, because that's all rental. And that's what we've already done today. To kind of work it out. Okay? Thank you, Bob.
Oh, my God. I don't know if I saw it, but I and then I went and go and fix the